The US Strategic Reserve is a $1 trillion lie that will kill the dollar. The price board flips to $8.09 a gallon as a trucker kills his engine and just stares. At the White House, phones light up. Down in the Gulf, two of the Strategic Petroleum Reserve sites sit dark after a storm knocks power. Traders smell blood. Treasury calls DOE, how fast can you move barrels? Here's the gap. The SPR was built to be a shield in real emergencies. Somewhere along the way, it became a lever for headlines. One shipment, one policy tweak, one blackout. Watch how they tie together. To understand the trap we set for ourselves, we need to go back to the beginning. The reserve that wasn't, origins and intent. The first alarm rang in 1973. Tankers slowed, prices spiked, and Americans lined up for hours to buy whatever gasoline was left. The embargo didn't just bruise the economy, it exposed a dependence no one could ignore. In the scramble, Congress wrote a simple idea into law in 1975. Store oil underground so a foreign shock can't knock the country off its feet again. They chose geology as the vault. Along the Gulf Coast, massive salt domes sit like buried mushrooms, soft and self-sealing. You drill down, flood the salt with water, dissolve a cavern the size of a skyscraper, and you've built a tank that doesn't rust. Then you fill it, sour grades, sweet grades, matched to what refineries actually run. Bryan Mound near Freeport, Texas, biggest of the lot. West Hackberry in Louisiana, another giant. Big Hill outside Beaumont. Bayou Choctaw near Baton Rouge. 4 sites, dozens of caverns. The design drawdown measured in how many barrels you can actually move per day, not just how many you can brag about on a spreadsheet. When full, the system could push well over 4 million barrels daily onto the market. That was the point, barrels you can move. Early on, emergency meant war, embargo, or a hurricane that tore through platforms and pipelines. Releases were rare, and even the threat of them mattered. The world saw those caverns as a promise. If supply broke, the United States could keep its machines turning long enough to fix the break. That credibility did something subtle. It made allies more comfortable holding dollars and planning in dollars because the fuel behind their economies had a dependable backstop. Meanwhile, the plumbing grew around it. Pipelines tied the sites into refinery hubs, Houston and Texas City via the Seaway system, Beaumont, Port Arthur and Lake Charles through Texoma links, Baton Rouge and New Orleans via Capline spurs. Pumps, valves, meters, and the power to run them, because a reserve is only as good as its deliverability. Engineers obsessed over flow rates. Can you sustain the draw for days, weeks? Can you get the right grades to the right refineries without gumming up the lines? In those early decades, the quiet norm held. The reserve deterred by existing. Presidents mentioned it when they had to. Markets priced in the possibility without ever calling the bluff. And that posture fed back into something bigger, a credibility loop tying physical energy to financial confidence. US policy said we'd keep supply stable. The barrels underground made that believable. Partners held dollars and treasuries more comfortably because the energy system under the dollar had steel and salt behind it. But there was always a caveat embedded in the geology. Caverns creep. Salt flows slowly like glass. You have to maintain caverns, degas oil, monitor brine pressures, manage integrity. Deliverability isn't permanent. It's engineered, tested, and defended. Every year you don't invest, your drawdown rate shrinks a little. The reserve was never a trophy. It was a machine that needed attention. Then the first hairline crack appeared, not in the rock, but in the rules. Congress realized you could sell a little oil to pay for something unrelated to energy and call it mandated. The temptation wasn't dramatic at first. A few million barrels here, a highway bill there. The markets barely noticed. Inside DOE, a few engineers grumbled that if you nibble the edges of a parachute long enough, it's still ripped when you need it. Even before the big political fights, another constraint was hiding in plain sight: location. Putting the reserve on the Gulf made sense because that's where refineries sit. But clustering adds weather risk, shipping risk, and power risk. A storm that takes out transmission lines strands barrels until generators roar back to life. A port closure queues tankers and forces refiners to cut runs. The original designers knew this. They built redundancies and mapped contingencies. Still, every design has limits. By the late 1990s and early 2000s, The definition of emergency started to stretch. Coordinated International Energy Agency releases for a war here, a hurricane there, defensible but also convenient. Each one taught markets a lesson. Washington could and would move barrels to smooth price spikes. Allies learned it too. And here's the quiet irony: credibility depends on the barrels you can actually move, not the press release. If you burn deliverability in a calm sea, you don't get it back when the storm rolls in. The Reserve's founders didn't write a marketing plan. They built a hedge against low-probability, high-impact events, an embargo that chokes supply, a canal closure that traps shipping, a cyberattack that freezes pipeline controls. The promise wasn't cheap gasoline, it was continuity, enough time to repair the link between wells, ships, pipes, and pumps without breaking households. The story worked as long as the machine worked. What nobody outside the control rooms tracked closely was the meter on the machine itself. Flow rates, power dependencies, maintenance backlogs, and the quiet shift in how politicians talked about those caverns. Because once you treat a shield like a wallet, the balance never looks the same again. Mission drift from shield to piggy bank. The first time Congress sold oil for something that had nothing to do with a crisis, it passed quietly. A mandated sale tied to a budget patch, because oil in a salt cavern is easier to tap than political capital on the Hill. It worked once, so they tried it again. Over a decade, strategic barrels were pre-scheduled for auctions to fund highway bills, drug approvals, deficit trims, everything except an actual energy emergency. Each sale was small enough to ignore, but together they taught a new lesson. The Reserve could be raided without consequence. Inside DOE, the engineers measured consequence in inches and hours. Cavern integrity budgets stretched, degassing cycles slipped. A pipeline valve needed refurbishment got another quarter. Drawdown drills ran with older equipment and thinner crews. Up on TV, you heard tidy phrases: congressional direction, prudent asset management. In control rooms, you heard a different phrase: if you don't test a parachute under load, you don't know it opens. Then came the softer misuse, market smoothing. White House aides discovered that saying you're considering a release can knock $1 off the front-month price. A well-timed leak to wire service, a "we are monitoring markets" podium line, a consultation with the IEA, not a hurricane, not a war that cut supply, a bad headline at the pump. Traders started gaming the cadence. A DOE official once told a colleague, "We're not a price tool." But the quotes rolled on, and the screens blinked red to green. By the mid-2010s, planned sales sat on calendars alongside maintenance outages. The Reserve became a budgetary assumption. The signal to allies and producers changed. If Washington would sell into rallies and jawbone dips, the deterrent premium, the market's quiet belief that a backstop exists, thinned out. OPEC Plus noticed. Algos noticed. A price spike that once triggered caution now triggered a chorus. Will they dump barrels again? Here's a micro story. A senior cavern engineer wrote a memo about flow rate degradation at one site, older pumps, reduced power redundancy, silt at a manifold. He warned that the advertised design draw might not be achievable without a maintenance window. The memo wound its way upward into a policy office already drafting a release option to counter a refinery outage on the East Coast. The outage cleared in days. The memo sat. The release went ahead anyway. Nobody checked whether the drawn barrels matched the grades refineries needed that week. Crosstown, a commodities desk built a model that scraped DOE press releases, IEA communiques, and social chatter from Hill staffers. They got good at fading the first rumor and selling the confirmed release. It wasn't insider trading. It was pattern recognition. Each draw that wasn't tied to a genuine supply shock made the next one easier to predict. The Reserve lost a little more of its mystery, and with that, a little more of its power. The volumes tell the same story. Emergency releases were once episodic and sharp, tied to hurricanes or wars. Planned sales, by contrast, dripped out steadily. Even the big 2022 release, triggered by a real global disruption, came layered on years of drip erosion. The scale was unprecedented, the intent mixed. Yes, it added barrels to a tight market. It also tried to cap prices. The refill plan assumed a swift re-entry at cheaper levels, but budgets, price floors, and timing collided with reality. Windows passed. Offers got rejected as too expensive or off-spec. Every missed refill kept the net position weaker. Stakes escalated beyond fuel prices. Every non-emergency draw recalibrated expectations at Vienna meetings and in Riyadh offices. If Washington used the reserve to manage domestic optics, producers could manage supply to box Washington in. The therefore kicks in. Therefore, the marginal barrel's power migrates toward coordinated exporters who can offset U.S. releases with targeted cuts. Therefore, volatility that used to sit in crude curves seeps into currency hedges and debt markets. What nobody in press briefings said out loud was the deliverability math. You can sell 10 million barrels a month on spreadsheets and still choke on valves, port congestion, and Jones Act constraints. You can announce a 30 million barrel draw and deliver half to the wrong place at the wrong time because a storm rerouted tankers and a pipeline operator prioritized contracted flows. The reserve's credibility isn't measured in total barrels. It's measured in the speed and suitability of barrels to the specific refineries that keep diesel, jet, and heating oil flowing. Meanwhile, the quiet norm of deterrence by existence frayed. The more the reserve was used to massage prices, the more markets discounted its future threat. It's the boy who cried barrels. Each time Washington reached for the lever without a true emergency, it told the world the shield was a wallet, and wallets empty faster than shields crack. Mission drift wasn't a headline moment. It was a string of small choices that turned an insurance policy into a political tool. It felt practical in the moment: ease a budget fight, calm a summer spike, score a point. But it changed the story other players told themselves about the United States, that the backstop might be there, but it might be thin, slow, or misaimed. And once that belief shifts, it doesn't shift back with a press release. The Petrodollar's quiet contract. While that mission drift played out on the Gulf Coast, something quieter anchored the financial world far from the salt. Oil was priced in dollars, and that choice shaped how money moved, not by decree carved in stone, but by habit, plumbing, and a bargain most people never saw. Producers sold crude in greenbacks. Importers kept dollar balances to pay them. Those balances didn't sit idle. They cycled into treasury markets, bank deposits, and swaps that greased global credit. Oil flowed, dollars moved, and both systems reinforced each other. To understand why, we need to step into the back office. A cargo of crude clears in dollars. The buyer's bank lines up payment through correspondent accounts, eurodollar deposits, or a swap that turns local currency into dollars at the right moment. The seller's central bank or sovereign fund takes the proceeds and needs somewhere deep and liquid to park them. US treasuries become the default because they're vast, because they settle cleanly, because custody services and repo markets exist to make them useful collateral. Oil creates a steady rhythm of inflows. The dollar system offers a drum to beat on. There was another layer: security. For decades, Washington offered something producers cared about: a predictable geopolitical umbrella and a vested interest in keeping sea lanes open, pipelines stable, and shocks contained. In return, pricing oil in dollars made practical sense. It reduced exchange risk for global buyers. It gave producers a single liquid pool to store wealth. And through 1,000 quiet transactions, it kept demand for dollar assets healthier than it would have been otherwise. Meanwhile, the banks built tools on top of this base. Eurodollar markets, dollar deposits outside US jurisdiction, grew into a shadow ocean where oil firms hedged cargoes, airlines hedged jet fuel, and traders financed floating storage. Swap lines and FX forwards turned future oil deliveries into predictable cash flows. Custody relationships let producers hold treasuries while pledging them overnight for cash. Every invoice in dollars knitted another stitch between energy and finance. Here's what nobody brags about at podiums: this loop thrives on credibility, not speeches, capability. The belief that the United States can dampen supply shocks, keep freight insured, deter choke point chaos, and deliver barrels when storms hit. The SBR's physical promise supported that belief. It said, in effect, we can buy time. Markets don't need perfection, they need a floor. The reserve, the Navy, the insurance backstops, the pipeline redundancies, together they made the dollar the least worried seat at the table. But fragility lives in the seams. When producers saw sanctions reshape payment routes, they tested alternatives. A few cargoes settled in local currencies. Discounted barrels moved with new intermediaries, insurance from friendlier flags, and creative invoicing. Central banks that once added treasuries like clockwork started adding more gold. Not a stampede, but a shuffle, portfolio managers calling it diversification, not rebellion. Meanwhile, the petrodollar's pillars, liquidity, custody, legal certainty, still towered over any rival. Yet the conversation had changed. What if you didn't need dollars for every barrel? Parallel to that, the plumbing showed strain. Sanctions compliance made some banks stricter about correspondent relationships. FX swap markets occasionally kinked under stress, pushing up the cost of turning yen or euros into dollars. When that happens, energy firms don't stop buying crude, they pay more for the currency. That cost bleeds into refining margins, freight rates, and eventually consumer prices. In quiet quarters on trading floors, risk managers widen their scenarios. Dollar funding tightness, insurance premiums for certain routes, outages on the Gulf colliding with a policy misstep. This was the moment everything started to hinge on deliverability, not just denomination. If the US could guarantee energy stability, physically, not rhetorically, the dollar's convenience remained unbeatable. If it couldn't, the conversation shifted from why change to why not hedge. A refinery in Asia experimenting with a non-dollar invoice isn't a revolution, it's an option. A producer agreeing to partial settlement in another currency isn't a manifesto, it's leverage. But options and leverage add up. They alter expectations. An oil minister once summed up the logic privately: price in what buyers can finance easily and store wealth where you can move it in a crisis. For decades, that answer was the dollar for both. It still is mostly. The euro-dollar ocean remains vast. Treasuries still clear fast. The custodians still carry trust. Yet the more Washington uses energy tools for short-term optics or lets physical backstops wither, the more room other answers get. A little more yuan or rupees at the margin. A little more gold on the balance sheet. A little less automatic recycling into US paper when prices are high. Here's the rub: you don't need to replace the dollar to raise America's bill. You just need participants to require a higher premium to hold it, hedge it, or lend against it when oil volatility feels unanchored. The petrodollar's quiet contract isn't a treaty, it's a repeated choice based on ease and confidence. Erode the physical assurance under it. Barrels you can move, routes you can protect, disruptions you can smooth, and the financial preference softens. Not in headlines, but in basis points, in custody allocations, in the currencies stamped on a handful of invoices that wouldn't have dared stray a decade ago. So the loop runs both ways. Physical credibility supports dollar demand in energy. Dollar demand lowers financing friction for energy. When the first side slips, the second side starts to hedge. And once hedging becomes habit, getting the habit to stop takes more than a statement. It takes barrels delivered when the lights are out. Geography of vulnerability, the caverns and the coast. To see the risk we never priced, trace a finger along the Gulf. 4 dots: Bryan Mound near Freeport, Big Hill outside Beaumont, West Hackberry in Cameron Parish, Bayou Choctaw near Baton Rouge. They sit close to what they feed, refinery corridors stretching from Houston to New Orleans. That proximity is strength on calm days, weakness when weather turns, power fails, or ships stack at anchor. Start with deliverability, not inventory. The sites tie into 3 main arteries. Seaway links Bryan Mound to Houston, Texas City, and Freeport. Texoma connects Big Hill and West Hackberry to Beaumont, Port Arthur, and Lake Charles, with limited reach toward Houston. Capline pulls Bayou Choctaw toward Baton Rouge and a sliver of New Orleans. Those pipes are the reserve's legs. Without pressure, pumps, and open berths, stored barrels are just numbers in caverns. Meanwhile, everything depends on electricity. Cavern pumps, brine circulation, meters that verify custody, all of it rides the same grid storms love to knock down. Hurricane hits, transmission towers bend, substations trip, and suddenly the advertised drawdown rate becomes a wish. Backup generators can bridge hours, sometimes a day. But sustained high-rate draws require stable power, stable pressure, and people on site who can cycle valves in sequence. That's the first fragile link. Now zoom to the water. The Gulf is a conveyor. Supertankers queue at ship channels dredged to tight tolerances. A shift in draft limits after heavy rains, a barge incident at a bridge or a fog shutdown, and pilots delay traffic. When ports choke, Refiners cut runs to avoid filling tanks to brim. If you're pushing crude out of caverns while docks slow, you're pushing into a traffic jam. The reserve's barrels need destination capacity, not just pipeline right-of-way. There's another quiet constraint, the Jones Act. Moving crude between U.S. ports requires U.S.-built, U.S.-flagged ships. In a pinch, waivers can move product, but they're political, slow, and contested. If you need to route crude or products around a closed pipeline segment after a storm, your marine options are narrower than most people think. That's not a scandal, it's how the law works. But it turns geography into policy, risk the moment you're improvising. Grades matter too. Gulf refineries are tuned, some to heavy sour, some to lighter sweet. The caverns hold both, but not in equal measure and not at every site. Deliverability is grade-specific. Push the wrong barrels to the wrong refinery, and you get yield losses, off-spec product, or slower crude units. That mismatch isn't academic. It shows up as diesel shortages even when total crude looks adequate on paper. Here's a simple outage chain. A late-season storm sweeps through. West Hackbury loses grid power. Pilots suspend movements into the Calcasieu ship channel. Texoma's downstream capacity tightens as operators prioritize contracted flows over emergency allocations. At the same time, Bayou Choctaw keeps pumping, but Capline's receiving end is throttled by rain-swollen rivers, restricting barge traffic upriver. Refiners in Lake Charles and Baton Rouge trim runs to avoid tank tops. Spot diesel in the southeast gaps higher, truck stops ration during peak hours. 2 days later, freight bids climb, grocery distribution centers adjust reorder points, and a week after that you feel it in produce prices. While that's happening in Louisiana, something else is happening in Texas. Bryan Mound has power, but Seaway's maintenance window, scheduled months earlier, collides with unexpected fog delays at the Houston ship channel. Crude backs up inland. The reserve could theoretically swing grade and destination via swap deals, but swaps take paperwork, quality assurances, and inspection time. Traders can reroute on common carrier pipelines, but those lines are full when forward spreads incentivize storage. A release becomes a trickle. The point is simple: clustered assets share failure modes. A geographically concentrated hedge isn't a hedge, it's a bet on clear skies and synchronized logistics. The original planners knew hurricanes were the big risk. What's changed is the density of everything around the reserve: more refineries, more chemicals, more ships, more people, more infrastructure interlocks. A down transmission line today cascades through a far more crowded map than in 1986. Then add the maintenance clock. Caverns creep, wells age, manifolds silt. If degassing cycles slip and pump overhauls stretch, the maximum sustainable draw shrinks before a crisis starts. That's the hidden timer running beneath policy debates. You can refill inventory after a big sale, but you can't refill lost deliverability overnight. It's earned through years of boring work that rarely makes news. None of this argues against Gulf storage. It argues for redundancy beyond it. Inland buffers tied to multiple pipelines, hardened power with islanding capability at each site, pre-negotiated marine contingencies that kick in automatically when pilots suspend traffic, grade-specific stocks aligned with refinery slates, verified quarterly, not annually, and a release rulebook that starts with logistics reality, days to market by grade and destination, before press statements. Because when you promise barrels and deliver delays, the market learns, producers learn, currency desks learn. The next time phones light up and a trucker stares at an $8 board, the question won't be how many barrels are in salt. It'll be how many can you move to where by when. That's the map the system never priced, and the one it trades on in the dark. The big drawdowns, when temporary became structural. 3 dates set the rhythm: crisis, discretion, mega release. The timeline reads like a pulse that got faster as politics crowded out patience. Start with the old pattern. After major hurricanes in the 2000s, the reserve opened briefly, targeted exchanges, barrels loaned to refiners when offshore platforms shut and pipelines stalled. Those draws were surgical. Caverns flowed, refineries kept units warm, and the oil cycled back once production recovered. Temporary meant measured days, then refills. Markets treated it as a fire drill, not a subsidy. Then discretionary sales crept in. Congress codified barrels for budgets years in advance. Small drips hit auctions, unrelated to storms or wars. The reserve's net position slid. The distinction between contingency and convenience blurred. Deliverability quietly tightened as maintenance stretched, but spreadsheets still showed comfort in headline totals. Temporary meant calendar management. 2022 flipped the scale. Russia's full-scale invasion of Ukraine shunted a massive volume of crude and products out of established routes. Insurance prices jumped, freight rates surged, and European buyers scrambled. Washington fired the biggest shot in SPR history, roughly 180 million barrels across months, aligned with allies. The rationale mixed emergency and price. The objective was twofold: fill the physical gap and lean on gasoline costs that were tearing into household budgets. At control panels, it felt like sprinting a marathon. Caverns cycled harder. Quality management got tougher as older stocks needed degassing or blending to meet specs. Deliveries flowed, but not uniformly. Some batches reached the wrong hubs for the grades refiners craved. Still, the sheer volume steadied a panicked market. The question shifted to the sequel: how fast do you refill? Officials promised to buy back at or below certain price levels, numbers that made sense on paper when forward curves dipped. But windows narrowed. Producers defended price bands. Offers for the right quality and location came in higher than hoped, or logistics made them impractical within bid terms. The cash left from sales met budget ceilings and procurement rules. A few million barrels trickled in. More was secured, on paper, by canceling mandated sales. The net barrels didn't climb back to comfort. Meanwhile, algorithms learn the cadence. Announce a tender, prices front-run it higher. Cancel a tender, prices sag, but refill slips again. The US became a visible, somewhat predictable actor whose constraints were public. OPEC Plus adjusted. Cuts appeared when releases loomed, extending tightness just long enough to blunt price relief and keep refill uneconomic. The chessboard tilted toward the side that could move quietly and indefinitely, not the side that needed appropriations and press lines. Producers outside the cartel watched too. Shale had discipline this time. Investors demanded returns, not reckless growth. Elasticity that once stunned markets in the 200s now felt stiff. With fewer wildcat barrels rushing in, the reserves draw loomed larger as a swing factor. Each month it sold was a month that taught exporters they could calibrate to it. The math turned from barrels to options. With a thinner cushion, every new disruption, hurricane, cyber incident, a refinery fire forced harder choices. If you drew again, you risked pushing refill further into an unfavorable price band. If you didn't, you risked pump pain and political blowback. The deterrent premium faded. Futures curves, once damped by the belief in a rapid draw, started embedding more volatility into later months. Currency desks priced more hedging around inflation bursts tied to energy spikes. Bond markets nudged yields higher to compensate for the risk that policy would chase prices with fewer tools. On the ground, micro mistakes echoed. A batch of sour crude released into a system short on distillate didn't solve diesel scarcity. A pipeline segment under maintenance limited routing to the very refiners that could crack heavy barrels efficiently. The reserve's ability to shape specific product outcomes, jet, diesel, heating oil, looked weaker than its headline volume implied. Deliverability, always grade and destination specific, became the constraint that mattered. By year-end, after the mega-release, inventories sat near multi-decade lows. DOE pointed to purchases at prices below the average sales price, a true win per barrel. But net position is more than unit economics. It's optionality, how many days you can sustain the right flow to the right place under stress. Optionality was smaller. The gap between barrels in salt and barrels you can move widened. Markets adapted. Traders widened spreads around Gulf storm seasons. Refiners padded inventories ahead of shoulder months. Exporters leaned into bilateral deals that reduced exposure to US signaling. Each adaptation was rational. Together, they signaled a world where the American backstop wasn't automatic. This was the inflection where temporary hardened into structure. Planned sales had become policy habit. Emergency draws scaled into a tool with refill friction. Announcements moved prices less. Cuts abroad countered releases faster. The reserve still mattered, but its leverage thinned. And here's the cost that doesn't show up in a weekly balance: credibility rent. When people doubt the speed, suitability, and staying power of a draw, they demand a premium elsewhere. FX hedges pricier, freight charters more cautious, inventory buffers fatter. Spread that across an economy, and you've taxed your currency's privilege in basis points. The bill comes due not in one headline, but in every financing tied to energy risk. Without a credible backstop, shocks don't just spike crude, they ricochet into the dollar. The system starts bracing before it breaks. Supply shocks aren't hypothetical. 3 days before prices jumped, a storm spun up faster than forecasts. It wasn't a monster on satellite, just tight and mean. It clipped the Gulf, dropped 2 transmission corridors, and left West Hackberry and parts of Big Hill on generator power. Pilots halted traffic into Calcasieu. Pipeline operators shifted to minimum flows to protect pressure. On paper, the SPR still held hundreds of millions of barrels. In practice, the first 48 hours were a crawl. Meanwhile, something else was happening 6,000 miles away. A bulker grounded in a narrow stretch of canal and wedged just wrong. Tugboats swarmed. Insurance desks reassessed route risk. Freight rates moved first, then premiums for time charter cover. The oil wasn't missing, the clock was. Delivery windows stretched, and contract language that looked boring last week suddenly mattered. Now layer in a micro-story. A tanker captain idled outside Lake Charles as weather windows kept closing. He'd been on schedule to discharge crude that a refinery counted on for its vacuum unit. His crew watched the channel like a hawk. Every hour on standby burned fuel and money. He radioed updates no one could accelerate. The refinery scheduled a rate cut. Unknown to them, across town, a grid operator was rationing restoration crews. Priorities stack in storms, hospitals first, then water plants, then industrial feeders. Cavern pumps sit in that third tier. They draw big power, and they don't get flipped on and off like light switches. To protect equipment, you ramp carefully. Every careful ramp shaves deliverability right when speed matters most. An airline hedger stared at a jet fuel curve that kinked. The refinery run cut translated into fewer barrels of distillate within days. He'd hedged price, not availability. That's a different problem. Spot cargoes existed in the Gulf, but the terminals that could take them were jammed. He called brokers anyway. The quote came back with a number and a shrug: if the berth frees up. Here's where the Jones Act bites quietly. A major pipeline segment inland scheduled a maintenance pig. With fog delaying barges and pilots suspending ship moves, moving product coastwise could have relieved pressure. But Jones Act tonnage was tight and expensive in the exact window needed. Waivers aren't a phone call, they're a process, and the argument for them competes with a law that protects a shipbuilding base. So trucks picked up slack. Diesel bills climbed. The clock kept running. Deliverability math is cruel under stress. Caverns hold mixed grades. The site with power might have sweeter crude, but the refinery short on diesel yield is tuned for heavier sour. You can't wish a barrel into the right API and sulfur. Blends are possible, but quality assurance takes time and labs, and you don't blend at peak draw without risking off-spec surprises. So you move what you can, where you can, and that mismatch shows up in product cracks. Diesel tightens first. Price pass-through has a rhythm. Day 1, rack prices for gasoline barely twitch, retail has buffer, diesel racks move faster. Day 3, truck stop boards bump. By the end of week 1, shippers add surcharges. Grocery buyers push back orders, then lighten assortments. A family sees it a week later at checkout, fewer deals, higher staples. That's not a policy failure in one office. It's the compounding effect of thin buffers. Politics heats up on cue. Cameras turn to podiums. The White House asks DOE for options. Release is the verb everyone knows, but tanks are light, and the sites with the best connectivity are the ones wrestling with power and ship traffic. A token tender won't change near-term product availability. A large tender risks chasing price higher and signaling panic. Either way, markets sniff it. Futures gap on the rumor, then whip on the clarification. Producers watch and adjust leverage. OPEC Plus doesn't need a press conference to move sentiment. A modest cut, timed to coincide with a US debate over releases, reinforces a price band. Russia reroutes barrels through shadow fleets, offering discounts in currencies that avoid sanction tangles. Bilateral deals firm up. The marginal barrel's power shifts another inch away from Washington's calendar. Parallel action continues. An insurer in London widens exclusions for ships calling certain ports until pilots clear the backlog. A rail terminal inland announces stricter scheduling windows to avoid congestion, which sounds orderly but reduces flexibility. A Jones Act operator raises rates to reflect demand. None of these moves is malicious. They're rational responses to tight systems. Together, they raise the hurdle for a clean, fast SBR impact. A grid line on a DOE console tells a smaller story. A pump at Bayou Choctaw is ready, but the brine system needs stabilization before you can push at nameplate. Operators wait for a pressure band to settle to avoid cavitation. That's 90 minutes. 90 minutes repeated across valves, manifolds, and meters turns into half a day you can't announce away. The public doesn't see valves, it sees prices. If you're in the cab of a long-haul truck, you see a spread between truck stop diesel and wholesale that looks unfair. If you're a grocer, you see a carrier adding an unprecedented volatility surcharge. If you're at Treasury, you see TIPS break-evens flare and the dollar wobble as FX desks pay up for energy-linked hedges. Policy options shrink as tanks get lighter. So yes, supply shocks aren't hypothetical. They're chains of mundane failures and reasonable decisions that together outrun a depleted backstop. In that chain, the reserve's promise is measured in days to market by grade, not just inventories. And when that promise thins, everything prices it in: the pump, the freight, the food, and eventually the currency. The producer chessboard: OPEC+, Russia, and shifting power. While Washington argued over tenders and optics, producers sketched their own playbook. In Vienna hotel suites and Riyadh offices, analysts mapped U.S. release patterns beside refinery maintenance calendars and hurricane seasons. They didn't need secrets. They had screens, history, and time. The lesson they drew was simple. If America uses barrels to ease domestic pain, then the marginal barrel should answer back, quietly, precisely, and at moments when refills are least convenient. OPEC+ became the metronome. The group wasn't a monolith, but its coordination stiffened after bruising price wars. Meetings turned into muscle memory: extend voluntary cuts a quarter longer, roll them with data-dependent language, leave just enough ambiguity to make traders hesitate. Cuts didn't need to be huge, they needed to be well-timed. Announce them when U.S. procurement windows opened, and you nudged offers above stated buyback thresholds. Say less, move the market more. Russia played a different board. Discounts eastward created a new web: shadow fleets, alternative insurers, and settlement in friendlier currencies. Each route made sanctions a little less binding and gave Moscow leverage: price support without a press conference, supply reallocation that landed outside the usual reporting windows. When a U.S. release dampened prompt prices, Russia throttled exports a notch, kept its discount tolerable for buyers, and let the global curve stay tight enough to frustrate refill math. Saudi Arabia kept the centerpiece role. Its calculus blended price bands with strategy hedges. Too low and budgets strain, too high and demand erodes and politics turn hostile. The kingdom learned to protect a range by acting alone when needed, then letting the group follow. Meanwhile, it diversified partnerships: Chinese investment, Asian refining stakes, long-term supply agreements that quietly anchored flow east. The message wasn't anti-dollar, it was anti-dependence. Signal that multiple routes exist, and the market prices the option. Non-OPEC suppliers provided the constraint set. Shale had learned discipline. Investors wanted cash, not explosive growth. That meant fewer rigs to chase spikes, more maintenance of flat production profiles, and less shock-absorbing elasticity. Brazil, Guyana, and Canada added barrels, but on project timelines, not Twitter timelines. Spare capacity, real, rapid, verifiable, lived mostly where OPEC+ chose to keep it. The swing barrel migrated back to capital that coordinated. Traders on both sides adapted. U.S. desks watching DOE chatter now watched OPEC+ guidance like bond traders watch central banks. A single line, voluntary cuts extended, subject to market conditions, became a macro input. Refiners timed turnaround seasons with an eye on quotas. The chessboard moved from "will there be barrels" to "whose signal wins the spread." Here's where OPEC+ learned Washington's rhythm. Jawboning is a currency too. If a U.S. official hinted at selling from the reserve, producers pre-hinted at trimming exports or extending restraints. If the U.S. opened a small tender, a few export programs slipped or maintenance extended at key terminals. None of it looked like retaliation. All of it trained algorithms to expect offsetting pressure. Over time, that expectation showed up consistently in pricing. Micro stories flickered beneath the headlines. A Saudi scheduling manager slotted cargoes to keep Asia whole while letting Europe feel tightness into winter. A Russian trader accepted rupee balances he couldn't easily recycle but prioritized continuity to cement non-dollar lanes. An Iraqi allocation shifted a hair to keep Basra grades scarce at moments when US refills targeted sour barrels. None of these moves dominated the tape alone. Together, they made the reserves' job harder. Meanwhile, producers watched the SPR's physical cadence. Drawdown profiles revealed which sites moved fastest, which grades cleared, which hubs mattered. If Bryan Mound flowed sweet to Houston, adjustments focused on sour availability to magnify diesel scarcity. If West Hackberry's power vulnerability surfaced, timing nudged around hurricane windows to compound strain. It wasn't malicious. It was rational strategy. Use your comparative advantage, coordinated spare capacity, to lean against an opponent whose response requires appropriations, logistics, and luck. As marginal power shifted, currency preference followed in inches, not miles. Energy ministries entertained partial settlements in non-dollar currencies for discount cargoes, not to dethrone the dollar, but to anchor new commercial ties. Central banks padded gold holdings at the margin. Sovereign funds diversified duration and geography. The dollar's liquidity halo endured, but the automaticity softened. In the end, the board looked different than a decade ago. OPEC Plus set tempo, Russia exploited gray lanes, Saudi Arabia balanced price, policy, and partnerships, shale stayed sober, and the US looked less like the unquestioned swing and more like a large player with visible constraints. When the marginal barrel's power moves, the marginal invoice's currency starts to flex. That shift doesn't announce itself. It shows up in basis points, in basis spreads, and in the quiet choices producers make when the phones light up and the caverns hum. The currency undercurrent, de-dollarization, or just diversification. From their perspective, the question wasn't ideological. It was practical. How much dollar exposure is smart when energy feels jumpier and policy feels louder? Central banks didn't dump treasuries, they shifted the mix. More gold slipped into vaults. Some reserve managers nudged allocations toward euros or yen. A few energy trades settled in alternative currencies, quiet experiments that would have been unthinkable when the backstop felt unquestioned. Meanwhile, something else was happening in commodity lanes. Discounts on sanctioned barrels opened the door to non-dollar settlements. Cargoes out of Russia cleared in yuan, rupees, or dirhams. Not everywhere, not always, but enough to prove the plumbing could be rerouted when incentives lined up. Banks in friendly jurisdictions extended correspondent links. Insurance found new flags. The goal wasn't to replace the dollar, it was to widen options. What nobody knew at the time was how quickly optionality becomes habit. A refinery that once defaulted to dollar invoices suddenly had a playbook. Partial yuan settlement tied to a long-term supply agreement with a currency swap layered on top. A sovereign wealth fund with oil cash to park didn't abandon treasuries. It trimmed duration, added gold, and held a little more liquidity at home. Each move was small. Together, they edged the system toward a world where the dollar remained dominant but less exclusive. Here's where the limits showed. The dollar's depth is still unmatched. Treasuries settle faster and scale bigger than any alternative. The eurodollar market provides funding at a speed other currencies can't copy. When stress hit, swap lines and repo markets in dollars still pulled the system back from cliffs. Even institutions exploring non-dollar deals kept their core cash in greenbacks because nothing else could carry that load. So call it diversification, not escape. But diversification carries a message. Confidence isn't infinite. Sanctions risk raised eyebrows. Payment networks look politicized. FX swap costs spiked during episodic squeezes, turning dollars temporarily expensive for non-US buyers. When those spikes coincided with energy volatility, hedging bills swelled. Risk officers, paid to be boring, reacted by spreading bets. Micro stories captured the mood. An Asian refiner accepted a trial contract invoiced in yuan for a slice of supply, with the rest still in dollars. It lowered headline exposure, gave leverage in future negotiations, and impressed a ministry that wanted strategic autonomy on paper. In a finance ministry elsewhere, A deputy governor argued for 2 percentage points more gold over 3 years, not because of doom, but because the carry cost felt acceptable insurance after a year of headline energy shocks. Oil invoicing experiments multiplied at the edges. A Middle Eastern producer priced a cargo to India with a rupee leg for services and a dollar leg for crude value. Another explored euro settlement for refined products into Europe. Most of these deals hid within broader relationships to avoid spooking markets or irritating established partners. They weren't declarations, they were proofs of concept. Meanwhile, the dollar machine kept humming. Custody networks in New York handled trillions with the flick of a keystroke. Repo markets recycled collateral overnight. The convenience premium stayed real. What shifted was the credibility test behind it. Can the US still underpin energy stability in practice when storms hit and routes clog? If yes, diversification stays cosmetic. If not, it compounds. Stakes sit in perception first, pricing second. If reserve mismanagement and bottlenecks suggest thinner buffers, investors demand slightly higher yields to hold dollar debt during energy shocks. FX desks widen spreads when oil spikes meet unclear policy responses. Those basis points matter. They're the invisible tax of doubt, paid every day across mortgages, corporate loans, and sovereign funding. According to the market's quiet scoreboard, gold buying by emerging central banks told the same story. Not revolution, reinsurance. A way to hold something that can't be sanctioned, that doesn't need a counterparty's balance sheet, that settles in a vault, not a ledger. It didn't replace treasuries. It supplemented them, a hedge against the small but rising risk that energy instability bleeds into financial friction more often. Here's the tension that defines this era. The dollar remains the easiest way to do almost everything that matters at scale, but ease relies on trust that the system behind it, energy included, will keep working under stress. The more the SBR is treated like a price lever or a budget slush, the more that trust asks for a premium. So when you hear de-dollarization, translate it to option building. Producers and consumers are testing non-dollar lanes, not to jump ship, but to make sure there's a lifeboat. If America rebuilds credibility with barrels it can move, signals it can keep, and infrastructure that holds under rain and wind, those lifeboats stay tied to the deck. If it doesn't, they start rowing. And once they're in motion, the current does the rest. The $1 trillion claim, what's the lie? Get this, the lie isn't a conspiracy. It's a category error, treating an insurance policy like a price tool and pretending there's no bill. The Strategic Petroleum Reserve was built to buy time in existential shocks. When it's used to massage headlines or plug budgets, you don't just lose barrels. You torch the deterrence premium that keeps markets calmer, freight cheaper, and the dollar easier to hold. Start with the accounting we never book. Hedging costs rise when energy feels unanchored. FX swap spreads widen when refill looks uncertain. Freight and insurance tack on storm premiums when deliverability looks thin. Every basis point looks trivial alone. Multiply it across mortgages, corporate funding, and rolling treasury issuance, and you're counting real money. Call it the volatility tax. You don't see it on DOE ledgers, you pay it in the price of money. Now add opportunity cost. Selling strategic barrels into rallies and planning to buy them back lower only works if you can actually refill on spec in the right locations with the procurement flexibility budgets allow. Miss those windows and you've inverted the insurance trade. You sold low-grade certainty and bought high-grade doubt. The per-barrel arithmetic. We sold at an average in the mid-90s and bought below 80, comforts a press podium. It doesn't restore optionality if deliverability degraded while you were saving pennies on procurement. Here's where the trillion shows up. It's not a single line item, it's cumulative risk priced into. Higher inflation volatility when diesel shocks pass through faster. Wider FX hedging costs when energy-linked importers scramble for dollars. A thicker term premium on treasuries when markets believe shocks will be met with fewer, slower tools. Inventory buffers that firms carry to self-insure what the SBR used to cushion. Over a decade, those drips add up. A handful of basis points on trillions of public and private liabilities isn't pundit math, it's compounding. The lie is claiming the reserve can be a piggy bank without making the dollar pay a spread. Then there's deliverability versus inventory, the accounting versus reality gap. Barrels in salt are not barrels at the rack. Grade mismatches, power dependencies, pipeline constraints, and port choke points turn headline volumes into partial credit. A market that once assumed a 4 million barrel per day design draw now discounts it for weather, maintenance, and staffing. That discount leaks into pricing long before any release. Futures curves embed fatter tails. Credit desks widen spreads for energy-sensitive borrowers. Insurance value destroyed is the part we hate to quantify. Before mission drift, the mere existence of a rapid backstop kept producers cautious about pushing spikes and kept consumers calmer about holding fewer buffers. That deter effect had cash value. When you spend credibility on non-emergencies, you have to buy it back with overinvestment. More maintenance, more redundancy, more transparency. We did the opposite, spent credibility, and trimmed the boring budgets that keep draw rates real. That gap is a liability, not a rounding error. Tie this back to the petrodollar loop. The dollar's edge rides on convenience plus confidence. Use the SBR as a price lever, and you risk signaling that the physical foundation is political. That pushes a sliver of oil invoices into other currencies, nudges reserve managers toward gold, and convinces traders to pay up for dollar hedges when oil jumps. None of that dethrones the dollar. It taxes it. A small, persistent surcharge on the currency's privilege is, functionally, a shadow deficit. What nobody knew at the time was how quickly patterns set. After 2022, producers learned to box US refills. Algorithms learned to fade jawboning. DOE learned that procurement windows close faster than press cycles. Households learned that release doesn't always mean cheaper diesel. And Treasury learned that energy anxiety can lift yields even when growth looks soft. So frame the claim clearly. The $1 trillion isn't missing from caverns. It's the present value of avoidable costs we incur when a strategic hedge is misused. Volatility premia, FX friction, debt service drift, inventory self-insurance, and lost deterrence that forces us to overpay later to rebuild trust. The fix isn't rhetoric. It's barrels you can move, rules you don't bend, and maintenance you don't defer. That's the bill for turning a shield into a wallet, and bills like that don't arrive all at once. They arrive every day in the price of money. Rebuilding deterrence, technical fixes, not slogans. To rebuild deterrence, start with rules that bind the adults in the room. Releases should fire only on triggers tied to physical disruption, not price optics. A defined percentage of Gulf production offline, a confirmed pipeline outage over a set duration, a verified shipping closure beyond X days. Post the triggers, live by them. If the storm passes and the threshold isn't met, you don't touch the valves. Markets learn you mean it. Procurement needs math, not press cycles. Tie refills to the forward curve using volume-weighted average pricing and transparent tender windows. When the 3-6-month strip trades below a published band that compensates for storage and logistics, bids go out automatically. When it rises, you stop. Publish a queue for accepted grades and delivery months so sellers can plan. Quiet beats clever here. Deliverability is the heart. Harden power first. Each site needs islandable microgrids, gas turbines or reciprocating engines with black start capability, diesel stocks on site, and priority feeders under hardened lines. Test them under load, not in tabletop drills. If pumps, brine plants, and meters keep running through a grid hiccup, your design draw becomes real again. Diversify geography. Keep the caverns on the Gulf, but add inland buffers. Lease space in commercial caverns tied into Cushing, Nederland, and Patoka via multiple pipelines. Small, distributed buffers, 10 to 20 million barrels each, reduce shared failure modes. They don't replace the SBR, they buy you routing options when ports choke or a site loses power. Build pipeline redundancy where it counts. Pre-negotiate interruptible capacity on common carriers that connect SBR legs to distillate-rich refineries. Fund strategic bidirectional upgrades on key segments so crude can swing north or east when the Gulf pinches. Don't guess. Run drills with operators, timestamp the valve sequences, and publish the achieved days to market by grade and destination. Grade strategy is a quiet fix with big payoff. Align inventories to refinery slates by hub, heavier sour nearer coker capacity, light a sweet where hydroskimming dominates. Stand up swap protocols with allies, Canada, Mexico, and select IEA partners to exchange mismatched grades in a crisis without waiting on new contracts. Pre-clear quality assays and inspection houses so swaps move in hours, not days. Firewalls against budget raids need teeth. Codify a strategic integrity statute that bars non-emergency disposals and mandates automatic replenishment plans after any draw, funded by a revolving account insulated from annual appropriations. If Congress wants barrels, it must meet the emergency triggers or pass a standalone vote labeled for what it is. Sunlight deters raids. Transparency should be cadence, not noise. Monthly capacity tests, 30-minute controlled pulses from each site, verified by third-party observers with results posted. Flow achieved, grade moved, destination connectivity, power status. Quarterly maintenance scorecards, degassing cycles, pump overhauls, manifold integrity. When markets see the machine hum, the deterrent premium rebuilds without you saying a word. Marine contingencies are the overlooked hinge. Lock in pre-arranged pilot surge protocols and berth prioritization frameworks that activate automatically when SPR releases are declared under triggers. Maintain a pre-approved roster of foreign flag waiver candidates with safety records that meet US standards, so a Jones Act waiver, if needed, isn't a scramble but a checklist. People don't love waivers. They love shelves stocked with diesel in week 2. While crude is king, products carry the political punch. Stand up a strategic product reserve in key corridors, ultra-low sulfur diesel and Jet A at inland terminals feeding the Southeast and Mid-Atlantic. Small volumes, tightly rotated through commercial racks, governed by the same trigger logic. If diesel cracks threaten freight, your first lever is product at the rack, not crude into a jammed port. Practice matters. Annual full-chain drills, valves, power, pipeline nominations, docks, swaps, and product draws run with industry participation and a post-mortem published like an NTSB report. Name the bottlenecks. Fix the ones you can before the next drill. What nobody admits is that drills write the story markets believe. If they're real, the story shifts. Data is the last mile. Build a secure, anonymized data-sharing pipe for real-time port status, pipeline line pack, terminal tank tops, and refinery unit outages during declared crises. Tie it to a plain language dashboard the public can see. When you move barrels, show the route, the grade, and the expected product outcome. The gap between announcement and reality closes when people can track the flow. Allies amplify the signal. Pre-sign coordinated trigger alignments with IEA partners so a US emergency declaration auto-cues allied releases size to their markets. Set up reciprocal swap windows to move the right molecules, diesel for crude, jet for sour, without haggling. Meanwhile, stand up joint tabletop exercises with Gulf producers on shipping security and canal contingencies. Quiet cooperation stabilizes routes, markets notice. Finally, own the dull budgets, ring-fence maintenance. Fund cavern leach, degas cycles, pump replacements, and power hardening as mandatory outlays, not discretionary trims. If you want a deterrent, you buy reliability. If you want the dollar's convenience premium back, you show capability, not commentary. No slogans needed. Just triggers, microgrids, pipes, grades, drills, data, and barrels that move when it's dark and raining. Allies, adversaries, and the shadow market. While Washington hammered out trigger rules and microgrid specs, allies and adversaries were busy rewriting the playbook that decides who has barrels when it hurts. On paper, the IEA promised coordination, verified stocks, timed releases, burden sharing. In practice, every government faces its own voters, its own refineries, its own politics. When a crunch hits, solidarity meets self-preservation at the terminal gate. We saw the split in small ways first. A European partner asked for diesel, not crude, because its refineries were already maxed on middle distillates. An Asian ally agreed to release crude, then throttled back when domestic prices jittered. None of it was betrayal. It was triage under pressure. Coordinated reserves work best when everyone's disruption looks the same. Lately, disruptions don't match. Meanwhile, sanctions carved a parallel world. Shadow fleets bought old tankers with murky ownership. AIS transponders flickered, went dark, reappeared with new names. Cargoes moved ship to ship at odd anchorages. Paper trails rerouted through friendly service hubs. Insurers outside London took risks the big clubs wouldn't touch. The data feed that analysts relied on turned grainy right when policy needed clarity. Enforcement strained by the day. Classifications blurred. Was that a sanction grade blended below a threshold or illegal cargo with sloppy paperwork? Compliance officers erred on caution. Cargo slowed while lawyers parsed clauses. Prices don't wait for footnotes. A refinery short on feedstock doesn't care if a ship's beneficial owner is a trust in a distant jurisdiction. It cares if the hose connects by Tuesday. Here's the stakes in human terms. An energy analyst at a policy desk stared at a flow model that used to line up to customs receipts within a percent. Now it was off by 5, then 8. She flagged unaccounted for barrels in a memo that reached the deputy's inbox the same morning. Cameras demanded a statement. The release, drafted overnight, assumed those missing barrels didn't exist. They did. They were just moving where the model couldn't see. By the time the statement aired, futures had punished the error. Adversaries didn't need to gloat. They just kept building lanes that ignored Western gatekeepers. Russia leaned on discounts and non-dollar settlements, turning opaque routes into durable habits. Iran and Venezuela, long practiced in cat-and-mouse logistics, found new brokers and banks to stretch enforcement capacity thin. Every additional workaround lowered the friction for the next cargo, the next invoice, the next insurer willing to play. Allies wrestled with their own blind spots. National stockpiles weren't uniformly audited. Some counted barrels that would take weeks to mobilize, others revolved product too slowly to meet quality specs when drawn. A partner's strategic liters of diesel turned out to be in tanks undergoing inspection. Another's crude buffer sat behind a pipeline bottleneck that required a waiver to reverse. Coordinated press conferences masked uncoordinated mechanics. Micro-stories dotted the map. A Mediterranean port refused a tanker after a last-minute insurance pull, forcing a detour that burned a week and $1 million. A Southeast Asian buyer accepted a cargo priced partly in local currency to secure steady supply, then discovered the swap market to convert receipts back into dollars was thinner than the term sheet implied. A West African exporter shifted classification on a blend to dodge a compliance tripwire. A month later, a product tank in Antwerp ran dry at the wrong time. Data opacity metastasized. Satellite images caught ship shadows, but cloud cover and clever transshipments blurred the tracks. Customs data lagged. Private trackers diverged by wide margins. Policymakers asked for a clean picture. Analysts gave confidence bands and caveats. Each caveat encouraged markets to add a premium for uncertainty. Spreads widened. Cargoes cost more to finance. The invisible tax thickened. The core capacity, trusted data, verified barrels, fast routing wasn't just a technocratic wish list. It was the difference between a release that calms and a release that confuses. Without it, policy response lags prices and prices drag currencies. You don't reassure an airline hedger with adjectives. You reassure him with a manifest and a timestamp. Sanctions weren't the only force splintering the map. Domestic politics inside allied capitals tilted priorities. Elections pushed leaders to hoard. Environmental rules tightened fuel specs that narrowed substitution options. Jones Act constraints at home rhymed with cabotage laws abroad. Each rule had a constituency. In a crunch, each rule became a friction point measured in hours and basis points. According to port agents and pipeline schedulers, the fixes are boring and urgent. Harmonize emergency product specs to widen substitutability. Pre-clear sanction-safe corridors with dedicated insurance pools. Standardize reserve auditing so available means days to market, not tank volume. Build a shared data pipe that resolves custody, route, and grade in near real time. Publish enough of it to anchor expectations without tipping adversaries to tactics. Because in the next crunch, the check won't be written in press releases. It'll clear in foreign exchange. If allies can't prove barrels and adversaries can hide them, markets will price that difference into the dollar first. And once that premium sets, it takes barrels, visible, verifiable, fast, to earn it back. The crisis drill, a near-future shock walkthrough. It starts on a Sunday night with radar that looks routine until it is. A compact hurricane kinks right, accelerates, and makes landfall between Sabine Pass and Cameron Parish. By dawn, West Hackberry is dark. Big Hill is on islanded generator power, enough to keep safety systems alive, but not to push sustained draw. Pilots suspend traffic into Calcasieu and Sabine Neches. The clocks in control rooms start measuring delay instead of flow. Therefore, Refinery runs along the Beaumont, Port Arthur, Lake Charles corridor tick down. Vacuum units that feed diesel look at dwindling crude receipts and ease. Jet fuel margins stretch as schedulers reshuffle barrels toward gasoline to calm headlines. Airline dispatchers cancel rotations to keep aircraft where fuel is certain. Crew schedulers spend the morning reassigning. Gate agents spend the afternoon apologizing. Therefore, the White House holds a call. DOE lays out options, a targeted release from Bryan Mound and Bayou Choctaw, with swaps to redirect grades to distillate-heavy refineries. But tanks are light. The last refill window delivered less than planned. Logistics projections show Seaway subject to a maintenance slowdown and Houston ship channel pilots enforcing daylight-only transits after fog and debris. Markets smell the bind before the briefing ends. Meanwhile, in Vienna, OPEC Plus announces a modest extension of voluntary cuts, only a quarter, data-dependent. Futures gap higher on opening. The dollar wobbles as FX desks buy protection against an energy-led inflation pop. Options pricing fattens on the right tail. US tender rumors hit the wire. Algorithms fade the rumor, then sell the confirmation. The cadence feels familiar. Human stakes come into view in small, hard choices. A Midwestern grocer's replenishment team cuts orders for perishables by 8% to keep freight bills from crushing margins. A long-haul owner-operator watches diesel at the truck stop jump 12 cents in 2 days and prints a temporary fuel surcharge on invoices he knows some clients won't pay. A school district transportation lead recalculates routes to save gallons, then emails parents about pickup windows shifting 5 minutes earlier. Impact slides quickly from terminals to screens at Treasury. Tips break-evens lift. The long end of the curve adds a handful of basis points as traders price the risk that policy will chase a cost shock with fewer levers. Cross-currency basis widens for Asia overnight as dollar funding tightens for importers hedging fuel needs. It's not panic. It's a tax on doubt, collected in real time. Back on the Gulf, Bayou Choctaw pushes, but Capline's downstream legs are constrained by high river currents restricting barge drafts. Bryan Mound's sweet flows into Houston are steady, yet the refineries short on diesel yield are tuned for heavier sour. Swaps are possible, but quality assays and chain of custody checks take hours that stack into days. The Jones Act becomes a silent character. Coastwise product moves that could relieve pressure depend on hulls that are booked. Waivers are debated, not granted. A DOE operator watches a pressure band on a brine system stabilize, then opens another valve in a sequence drilled 100 times. The site can sustain a controlled pulse, not a sprint. A generator at Big Hill needs a part trucked from San Antonio. The highway is open, but state troopers are escorting utility crews first. These aren't failures. They're the friction of reality when systems are tight. Unknown to officials in Washington, a cluster of shadow fleet tankers carrying sanctioned barrels diverts around a port where insurers pull coverage after a weather-related incident. Those ships will arrive later, if at all. The opacity creeps into models. Analysts mark a wider, unaccounted-for band. Policymakers talk in absolutes at podiums. Traders hear the hedging in their voices. By midweek, rack diesel is up 40 cents in some southeast markets. Gasoline holds flatter, which confuses the public, but makes sense to refinery planners juggling yields. Big box retailers lock in incremental rail to replace some truck lanes. Small manufacturers choose which orders to delay to avoid premium freight. The airline hedger who bought price protection still calls terminals hour by hour to find physical barrels for next week. Cameras chase an easy answer: open the reserve. The president announces a targeted, time-bound release and promises no hesitation on waivers and coordination. The language steadies some screens, but basis differentials in the Gulf widen anyway because barrels still have to move through specific pipes to specific cokers. A press release can't reverse a fog delay. Producers adjust leverage with a surgeon's touch. A Saudi program trims 2 cargoes east and delays a third west by 4 days Nothing headline-worthy, everything calendar-relevant. A Russian exporter shifts a parcel to an Asian buyer on Yuan terms, keeping the discount tolerable while signaling alternatives. The curve stays tight, where the US hoped it would loosen. Meanwhile, allies split along predictable lines. A European partner offers crude on paper but quietly asks for diesel instead. An Asian ally schedules a token release, then reroutes to domestic refiners when local prices flicker. Coordination exists, synchronized execution doesn't. The announcement to arrival gap widens. By Friday, the storm is gone. The backlog isn't. Pilots are clearing channels, line pack is recovering, power is mostly back. The reserve moved barrels. It just didn't move enough of the right barrels fast enough to bend product cracks where households feel them. Prices don't spike further. They plateau at a level that makes a weekly shop feel heavier and a bond auction feel touchier. The lesson isn't doom, it's credibility math. When tanks are thin and deliverability is fragile, every shock taxes money as much as it taxes fuel. You can't talk that premium away. You can only earn it down with triggers that make sense, drills that work, power that holds, and barrels that arrive where the diesel pumps are running, before the week ends, not after. Meaning, what we risk if we get this wrong. From their perspective, this isn't about speeches. It's about whether the United States still offers something the world can trust at 2 a.m. in bad weather. The dollar's edge always rested on two legs, trust and capability. Trust because counterparties believed we wouldn't blink in a crunch. Capability because, when tankers stalled and grids flickered, we had the muscle to steady the flow. Energy is the quiet wiring between those legs. If that wiring frays, the whole structure hums with noise. Mismanaging the reserve sends the wrong story to allies and producers. It says short-term optics can override long-term resilience. It tells engineers who sweat drawdown rates that their work is negotiable. It tells traders that Washington might trade physical assurance for a headline and then ask markets to believe the guarantee still holds. Producers hear that and pull options closer. Allies hear it and hedge. The response isn't anger, it's distance. There's a hidden tax in that distance. Inflation becomes jumpier when diesel spikes travel faster through thinner buffers. Financing costs creep higher when energy shocks trigger dollar funding squeezes. Companies carry fatter inventories as self-insurance, tying up capital that could have gone to hiring and equipment. Municipalities widen contingency budgets for fuel. Airlines roll more expensive hedges. None of this looks dramatic on one balance sheet. Across millions, it's a slow leak that never stops. Geopolitically, leverage shifts in ways you feel later. If OPEC Plus sets tempo and Moscow exploits gray lanes while our backstop looks soft, the price band we live in reflects their tolerance, not our confidence. That matters when you're sanctioning a regime, defending a sea lane, or asking partners to align on a crisis response. Every basis point added to our borrowing costs is fewer dollars for defense, infrastructure, or the next energy-hardened project we'll wish we'd built sooner. Here's the harder truth. The fixes aren't glamorous. Their maintenance windows met, microgrids tested under load, swap agreements pre-cleared, valves cycled in drills with stopwatches, and grade inventories matched to coker slates. Politically, that's boring. Strategically, it's decisive. Credibility is muscle memory, built in quiet rooms by people who will never stand at a podium. If you don't fund that memory, you pay for it later with volatility premiums you can't message away. Households sit at the end of this chain. A trucker staring at an $8 board doesn't care about euro-dollar plumbing. A school district trimming bus routes doesn't care about basis swaps. A family at checkout doesn't care if a cargo settled in yuan or dollars. They care that groceries didn't jump 7% in 3 weeks because a storm clipped a substation and the reserve couldn't move sour crude to the right coker in time. Protecting them from that whiplash is the point. Protecting the currency's moat is the same point, zoomed out. The dollar's convenience premium lives in the belief that the United States will show up with capability when it's dark and raining. When we treat the SBR as a piggy bank or a press tool, we borrow against that belief. The bill doesn't come from an auditor. It comes from traders who demand a little more carry, shippers who demand a little more rate, and central banks that ask for a little more gold. Those little mores add up. So the meaning is simple and tough. If we get this wrong, if we keep raiding barrels for budgets, blur release rules, and let deliverability decay, we will keep paying that hidden tax. It will show up in rent, in airline tickets, in municipal bonds, in the price of a loaf of bread after a Gulf storm that barely made landfall. If we get it right, the benefits won't trend on social feeds. They'll accrue in quiet, lower spreads, steadier shelves, calmer desks when headlines turn sharp. Back to the night prices spiked and phones lit up. The question the market asked wasn't how many barrels the United States owned. It was whether we could move them now to the right places, in the right grades, without breaking something else. Answer that with action and the premium shrinks. Fail and the meter keeps running. Resolution and broader meaning. Credibility lives in barrels you can move when it's dark and raining, and in the rules that keep hands off the valves until they're truly needed. If you want the sequel that ties this to grid fragility and the coming copper crunch, watch the next video. Subscribe for the real mechanics behind headlines, and share this if you want policy that protects families instead of optics.